Thanks for inviting us today. So I'm Vice President of Consulting Solutions for Consero. So I oversee a really nice new offering we've launched this year called Advisory Services at Consero that runs alongside our Finance as a Service offering with Consero. So that includes CFO advisory services, FP&A and reporting services, and some cleanup and technical accounting services. I've had the benefit of being a CFO for a number of different types of sizes of companies over the years, including startups, VC-backed, including working in large senior roles in companies like Cognos and IBM over the years, and have had a pleasure of working on CFO clients for Consero and its predecessor Positive Venture Group for the last 9 years. And I'll turn it over to Alan Wiley, who's the co-founder and CEO of Clipfolio, to introduce himself as well.
Thanks, Jeff. Thanks, Allison, for having me. So thrilled to be here. I'm the CEO of Clipfolio. We're a business analytics software provider. We're lucky enough to have a couple of thousand customers globally. And for the past X number of years, we have been thinking metrics and KPIs and helping a number of our customers think through that process. So this is a great place to have that discussion. So anyways, again, thanks for having me.
Great. So this is the type of content we're going to be covering today, and you'll see we have a bit of an industry skew to looking at companies that have a recurring revenue model as part of their business. A lot of my experience has been with technology-based companies and services businesses that do have a strong recurring revenue base. So we'll be covering that, including some KPIs associated with those business models. We'll also cover some tips for being data-driven, and we'll conclude with some final thoughts on the industry. Great. So we'll start off with some different types of recurring revenue models. And, probably the recurring revenue model that we all recognize the most is your sort of typical time-based subscription, whether that's an annual-based, maybe it's a lifetime-based, subscription. Some companies dabble in the worlds of monthly or quarterly subscriptions with some automatic renewal provisions. But then you'll also see that some companies go and expand beyond that. Maybe they do have a complementary consumption model that goes alongside their regular subscription. So whether that's your Netflix, where you're able to upgrade and buy some other premium, fresh events for an additional charge, or whether that's your printer who is now demanding a subscription for printer cartridges to your houses. Also, one nice element of subscriptions is building in automatic renewal provisions. It also gives you a nice opportunity to introduce price increases on some sort of a scheduled basis and see if your customers notice. And then also, some people have implemented different pricing models, which I tend to like. I've worked with a number of different companies that actually align their pricing to when the product is being used or when an outcome is being achieved. Sometimes they marry that up in terms of a hybrid of offering both a subscription and then some additional usage-based pricing as well. Some companies introduce per user or different pricing tiers into their subscription model, and others offer tiers in a different time frame. So whether that's a different combination of features, whether that's like a starter package and an enterprise premium offering. So one nice thing about working with some of these companies, a number of years ago, I worked with a SaaS-based company that really started off with a usage, consumption-based pricing model. Early stage investors were looking at that model and saying that it was really going to be difficult to finance that business, and they were trying to steer them to more of a subscription-based offering. But the customers really loved how disruptive that they were, and that they were pricing based on the outcome that the customer wanted them to achieve, and actually grew that revenue base very, very well over a number of years. And keeping an open line of communication with those different funding audiences allowed us to show that this reoccurring revenue model was actually financeable and maybe even better and stronger than just having a pure recurring model. Over time, being able to overlay different recurring element offerings alongside this consumption-based model allowed them to grow and kind of answer some of the questions of what investors were looking for.
Jeff,
yeah,
just thinking out loud, that's actually a really good point, right? Because the the subscription economy has been around for probably about 20 years now, moving or taking over from that perpetual or, the older type of licensing model. But it does put cash pressure on how you run your business. And this subscription or this recurring usage-based model, of course, means that cash is coming into your business much, much slower. So at the early days, if you're just starting up, there's a lot of cash pressure until you build up that customer base. So an upfront payment, or if you can do annual or multi-year deals, means that you can get the cash in the door right up front. But of course, your expansion revenue might be different. So these are things that you'd have to keep in mind too, as you mentioned.
Yeah, absolutely. But some of the companies that had a chance to work with, they actually, early days, it was really great to see that they didn't just align to maybe what their investors wanted purely. They found the right types of investors that understood their model, and that over time, that having that nice complementary usage-based alongside the subscription-based, certainly when they got to scale, got them beyond, to a healthier growth business.
Yep.
Yeah. Okay, we can go to the next slide then. So now we're going to jump into some important KPIs for recurring revenue business models. So firstly, on customer acquisition, this is an interesting point. Sitting as a CFO, it's been interesting to work with companies and be able to tell them you're not actually spending enough on acquiring customers, which seems a little bit ironic. Usually, it's the fun police when you're talking to your CFO. But it is pretty important to take a look at those metrics. We are trying to measure ROI. How long does it take to pay back those initial investments? But we're also going to notice when we're underspending in terms of how to acquire those customers. But how we acquire them, you could have a model that's driven more by sales headcount. You could have a product-led growth model where in fact your product is doing a lot of the hard work before a sales rep needs to pick up the phone and get involved in a sale transaction. So definitely a lot of different models to consider here, but an important KPI for each business to track.
Yeah, maybe I'll jump in and talk about the expansion side here as well. And this is often one of the most important mechanisms to reach that hyper growth stage. So expansion and retention. I'll let Jeff talk about the retention side, but the expansion is you get into a customer and you're either expanding the number of users or the number of queries or some sort of consumption metric over time. And not only is that an excellent way to grow the average deal size of each of your customers, but it's also a validation that they are seeing value in the product and starting to consume more, use more, and basically get more value out of the business. So that expansion side is critical, especially when we take a look at metrics such as net dollar retention or NRR, net revenue retention. At some point, you're going to reach a stage where you need to be getting more expansion revenue than you're churning. If you can't do that, your business is basically going to flatline. So really engineering a pricing model that allows for that expansion revenue is very critical to understand upfront.
Yeah, and we all know that acquiring a new customer is a lot more expensive than just retaining the customers that you have. Some studies have shown that it's 5 to 25 times more expensive to acquire a new customer. So retention is pretty paramount, and driving some of that expansion revenue. One of the nice things is being able to offer different services to the customers over time. Some companies offer certain types of insurance like payments related to their revenue stream, or even getting some sort of a take rate on actually processing the payment transactions as well, or some interesting ways to actually kind of grow your existing revenue base to help drive up those revenue retention numbers.
I think one last point here too. The one of the big differences between a perpetual model and a recurring model is that the onus is on you to keep that customer. Much more so in a recurring revenue business than on a perpetual model. So you're really on the hook to keep innovating and proving value and offering good customer support. Jeff, I'm going to start with this one, and feel free to pipe in. I've had the benefit of growing our company over the last 20 years, and I've also worked with a number of other startups and sat on boards. And I often like to think of companies as being in one of three stages, the way I simplistically look at it. And what I often find is that some executive teams, leadership teams are measuring things that really don't matter for the stage that they're at. Now, this isn't a cumulative or an additive type of model, but if you're in the very early stages of launching a product or even a service, it really means that you should be 100% focused on that product or service market fit. So measure the things that matter to that stage of company that you're at. And anecdotally, there's some softer non-metric type things that you want to be hearing. You want to be hearing people say, "Oh, I love this feature," or "If you were to take this product away, that would be a real huge pain." So definitely on the early stages where you might not have as much volume or as many statistically relevant numbers, you want to make sure that you're listening to customers and measuring those kind of feedback items. Now, there are things that you can measure, like net dollar retention is a great one. Are people buying more? Are they not churning? Net promoter score, like the NPS scores, your daily active users, they should be increasing over time. So all of those things are evidence of good product market fit. Only once you have that, and I pause on that because you can lose it too. So don't think once you have it, you've got it forever. You could lose product market fit as well. So you always have to be thinking about this at the fundamental level. But once you got that, then you sort of move into the growth stage, right? And your VCs will think about these things differently as well. So the growth stage is all about showing month over month revenue growth, account growth. You want to make sure that you're starting to think about efficiency and not losing accounts. You want to make sure that that NRR number is over 100%, so you're getting good expansion revenue. And then for the later stage companies, that's when you start thinking about efficiency. So what is the profit per employee? What is the revenue per employee? What is my LTV to CAC ratio and things like that? Those are all really good efficiency metrics. Now, you can look at those things early on, but keep in mind that sometimes they're not going to be as relevant early on as when you're in that stage and moving forward. But these are all additive. Like once you move to another stage, you're still monitoring those earlier metrics as well.
Yeah, and I would say for some of these metrics, it is pretty important to not just look at the average for all sizes of companies. Each one of these at various stages, you're going to see like the rule of 40 for earlier, stage companies that are less than 5 million is obviously going to be has opportunities to be significantly higher because you can achieve a much higher revenue growth rate coming from a smaller base.
Yeah. And I don't know if we're going to talk about that one later, but that rule of 40, that's one of my favorite super simple metrics. So if you don't know what it is, look it up. It's a nice one to use.
And ironically, this last year, I went to SaaS North, and they were sort of describing this is sort of the year of being the rule of 30, being the new rule of 40. But that's, I think we're hoping that we're coming out of those years of having to extend cash runway and be as lean and mean as we have been. I think we've learned some very important lessons in the last number of years that really kind of helps us in the years to come.
Absolutely. I mean, these are metrics that we've used over the past 20 years, but they shift depending on what your cash needs are and what the economy is telling you. And so there's a lot of movement around here for sure.
Great. Okay, so some key metrics. A lot of these you'll obviously recognize, but you're going to be tracking your MRR. You're going to be tracking your customer acquisition costs, and then you're going to start looking at payback period. Of course, keeping in mind what Alan said on the previous page about understanding what stage of the business that you're at and which ones to focus on the most. Customer churn's an interesting one, especially in type of business which is kind of usage based. It's almost a little bit of an experiment over time. This is where it's kind of important to say you might not have all the answers right away in terms of how to track KPIs, what all the data might need to be, but it's important to start thinking about it and tracking it early on. And then, with a business where, it's, entirely product or sorry, usage based, how do you measure churn? It's
Mhm.
it's interesting. You have to kind of look at different cohorts potentially of your customer base. You're going to have to look at different time frames. You're going to have to really challenge yourselves internally to think about what an appropriate definition of churn is for your business. But what you could easily do as well is leverage an industry benchmark and at least baseline yourself to see, are you improving? Are you moving the needle forward every single month
Yeah,
as you
customer
progress as a
churn or
business?
logo churn it's very binary. You're not getting a lot of nuance there. So you want to pair customer churn or logo churn with something like NRR or net dollar retention, because that'll tell you if they merely downgraded, that's still important to understand. They didn't churn, they didn't cancel, but they did downgrade. So NRR will show you that, but customer churn, of course, wouldn't.
Yeah, that's right. And so, yeah, the traditional, metric a number of years ago was your CAC to LTV ratio. But what I've seen more often in the last year and a year and a half in particular is really investors asking a lot about NRR for sure.
Yeah.
Yeah,
Yeah,
that's right.
the NRR I think is like the gold standard metric that everybody should understand and strive to improve.
That's right, because it's going to take into account all your expansion and your churn and measure it over, a time frame, a
Yep,
long enough time frame of your
yep,
business with that customer.
exactly.
Okay, next slide. Great, and we already touched upon the CAC to LTV ratio on the previous slide. And now, you get into average revenue per account or customer. You also see later on in the deck, we had a chance to, at SaaS North here from some thought leaders in the space, sort of redefining what some of the new metrics are sort of going forward. And they're talking about, ARR per FTE again with the,
Hmm.
special nuance in terms of why they were really taking extra particular attention to it. Especially in recent years with AI improvements, we're seeing, pretty dramatic increases, as companies have been forced to kind of extend cash runway and try to find different ways to kind of, grow the business versus sort of what was more pure traditional headcount driven, way of kind of building out your development team.
Yeah, I
S-
wonder if there's going to be a future, like average revenue or ARR to AI spend, like there's going to be future ratios and metrics that we probably haven't even dreamt of yet.
Absolutely. Yeah, and then some businesses both looking at your contribution margin, especially you have some pretty fundamental or important throughput costs. Taking a look at that distinctly and separately from your full gross margin, sort of your accounting purist view of the world, which includes the cost of your customer support team and your people
Mhm.
costs internally as well that are allocated to cost of goods sold. And of course, thoughts wouldn't be completed without at least a cursory look at the balance sheet in terms of understanding your burn, your cash runway. Always very important. A couple of years ago, if you were starting to get to 12 months of cash runway, maybe you're getting a bit nervous and alarm bells were going off at 9 months, and that has all tightened up quite a little bit in the last number of years where people get nervous earlier. So we've all learned those hard lessons in the last number of years about how to extend cash runway and find a different way to grow maybe a little bit closer to profitability. All right, well, next jump into some tips for being data driven.
All right, so I'll take this one. A lot of measuring your metrics and your KPIs. It fundamentally comes down to having good, trustworthy data, and there really is a massive variety of maturity levels that we've seen that people aspire to. So here's maybe a few points, and then I've got a link at the bottom that links out to what we've developed as sort of a data and metrics maturity model. You can sort of assess yourself, place yourself on it, and it looks at everything from data culture to, data strategy within the company to your data stack and how you're thinking about things. So it's a valuable little tool to look at. I think fundamentally, data needs to be looked at scientifically. So, is the business looking at data as a strategic asset? Are things being measured that are being decided upon? Just like the scientific process, is there a hypothesis? Are you testing things? Are you analyzing things? And that very much is not only a strategic decision for the leadership team, but it's a cultural one that you should move throughout the entire company. And that sort of gets us into the next one as well. So this idea of data transparency. The folks inside the company, the more they have access and understand what they're striving towards and how things are being measured and how they can move the needle, the more you're going to get that entire employee base really thinking on your behalf and thinking about things. We've met all sorts of folks that love looking at data, and many folks that actually are also even scared of looking at data and think it's almost an invasion on how they're performing personally at business. So I think this idea of coaching folks and making sure that data is an asset to be used and even to advance their careers is something that's super important. The other thing that we've started learning about over the past 5 years, and especially as your company gets bigger, metrics and KPIs need to be defined. I mean, how many times have you gone into a call or a meeting with a number of colleagues and somebody says, well, what was the sales last month? And everybody has a slightly different definition and a slightly different number. So I think that erodes trust. So that definitely needs to be defined. And then, of course, I already spoke to it, this idea of data quality, data governance. It needs to exist and it needs to be homogenous throughout the entire company. So again, check out that maturity model. I think there's a number of tips and tricks in there that might be helpful.
That'd be great if we could, start all meetings with our management teams without wondering whose version of the truth is the one we should be talking to today.
100%, 100%. It's one of the big killers of people believing in business metrics and KPIs.
Yeah, which is an important point here to sort of say what some of the things to be thinking about here. So recording the data, if it's important, you need to be measuring it. You need to be tracking it. It's important to have kind of the right team, the right systems to be tracking this early. This is an important time to maybe be, dressing for the job that you'd like to have one day, even if you're earlier on, to make sure you're on the right kinds of system and collecting the right types of data early on, even if you don't know how you're going to be using it necessarily later on. So tracking and measuring those early is pretty important. Looking and benchmarking it against some of your colleagues and peers, and analyzing it against your historical performance. All very kind of important things to be thinking about. So out of this SaaS North event, one great speaker that did go up. So you'll see a reference down there at the bottom. I encourage you to go read their site. They got some really interesting metrics. They're sort of taking a look at sort of 10 years later, after some of the original sort of foundational metrics of the the SaaS industry were created. What are some of the new things that people are taking a look at? We won't talk about necessarily all of these, but one of them I mentioned earlier is this ARR per FTE. The first time I sort of saw it on a slide, I was thinking about just like what's old is new again. I remember looking at this metric in a public company I was working for back in the early 2000s, and some of the metrics, I guess, in terms of looking at the metrics that were kind of commonly achieved in recent reports are very much aligned to almost what it was 20 years ago. But what has changed, like I mentioned earlier, is the influence of AI. People are looking at different ways to grow their teams and achieve higher ARR based on the number of headcount that they have. One other interesting area, I think, is how much product influence revenue. I've had the fortunate opportunity to work with a company that's got a product-led growth model to their business. And they designed their product from day one to sort of focus on that customer experience and make it very easy for customers to upgrade, move up to a higher tier, even to opt out of their subscription-based model and go back to a pay-as-you-go model so that they give the customer an offboard path, which doesn't mean that they have to leave. Building those things directly into your product so not everything requires a person to interact, is a great foundation. Of course, coupling that with a nice customer, service-oriented business where you're actually monitoring and staying ahead of those customer choices, and reaching out to them to try to engage them in why they're making some of those decisions, or seeing if you can turn what looks like an upsell maybe into an even larger relationship, understanding why they want to be moving to a different tier, gives you a chance to have a great conversation with your customer. And Alan, did you have you had a story on sort of cohort-based analysis as well,
Yeah,
right?
I was thinking if I should mention it. When we did our, I think it was either our A round or B round, one of our investors during the due diligence phase said, can you get me a cohort analysis? And of course I said yes, but what I didn't voice was I had no clue what a cohort analysis was at the time. So this is probably, I don't know, 6, 7, 8 years ago. To this day, it's probably one of the most important product metrics that we look at. Actually, product and sales metrics that we look at. It influences everything. So we look at cohorts by either when they started and are they upgrading, are they downgrading, or what channel they came in from. Was this a direct? Was this a PLG? Was this a sales led? So you can cohort any number of different ways and understand which ones are producing the highest NRR or the least churn. So yeah, that was one where I got nicely schooled by the investors, but it's turned out to be one of my favorite types of charts these days.
No, that's great.
And then I think on this slide, I think these are mostly my links here. And again, thanks for having me here, but I'm going to leave you with a few takeaways. For those that are just starting with KPIs and metrics, again, there's a link here. What is a KPI? It's a starting point, but it actually does go into quite a bit of depth about how to think about KPIs, how to structure them, the anatomy of a KPI. Metric HQ is a resource that I think everybody should check out. It's a huge library of mostly expertly sourced metric definitions. It has the formula there, so it tells you how you should be calculating it. There's some in-depth look of what you should be thinking about. And then, of course, also related metrics. Metrics should never exist on their own. There's always a leading or a lagging or a related metric that you should look at to understand the context of that. So Metric HQ is a huge online library of different metrics and KPIs. And then I already mentioned the metric maturity model. If you want to sort of see where you and your team fit inside of that journey, that's maybe a fun one to take a look at. I say fun, but I mean, it's got a lot of text there that I think is fun, but anyways, there's some good information there for sure.
Yeah, and one additional thought I might just throw in there, and it's been great to have you here today, Alan. Like especially in the business that I work with, that has a usage-based model. One of the things I do as the CFO for that business is literally every day I open a Klipfolio dashboard and I'm looking at daily metrics in that business. Investors are always interested in, what this next month will look like. And they're still a part of our business that we really use those daily insights, that immediate feedback to take action as a management team and to stay ahead of what this month's forecast looks like.
I couldn't have said it better, Jeff. Thanks for the little shout out. That's great.
Thank you. Yeah, and I just want to let everyone know that we will be sending out the recording and the slides. We did have a couple questions come in, so if you're able to stay on for a little bit longer, we'll answer those. So the first one that came in, so this person has a meeting component of service revenue in Outmix. Any suggestions for tracking and integrating service metrics in some of these KPIs? Most of the services are reoccurring each year. Reoccurring. So
is this a technical question on how to connects to and ingests the data? Or is it more of a question about, I mean, I guess we can't, this isn't a live question. I'd say from a technical point of view, there's almost most applications today, or most services today, have an API, or they have a REST API, or you can have a periodic export of data, an XML feed or a CSV feed that, you know, systems like ours can ingest. It's either that, or if you have a data team, you know, you would ingest that into a data warehouse like Snowflake or BigQuery, and then an analytical tool like ours can sit on top of that. So I think technically there's always ways that you can fetch that data, organize it, cleanse it, and then visualize it. I'm not as familiar, Jeff, maybe you're familiar with that service and the type of KPIs that they're speaking of.
Well, I've definitely seen, you know, having to solve the problem again with some sort of an aggregation tool where there's a workforce management, you know, part of the solution. There's time tracking that sometimes is part of the, you know, the inputs. You also want to find a way to have all that incorporate into your ERP. You want to make sure that you get a growing, scaling ERP that can handle all of your, you know, services, revenue recognition decisions as well. But finding the right sort of reporting tools that you want to aggregate and navigate through that data as well is a big part of it. And there are a lot of interesting, you know, tools out there. But I always find that getting more of it into your ERP and being able to consume it from one spot to me is, maybe I'm a little bit biased being the CFO, and that's where I spend a lot of time. But that's solving as much there as humanly possible, and then complementing it with that operational data, maybe in a BI tool is a great solution.
Great, thank you. And then one more, what are your top 3 KPIs, metrics that your personal preferences, and why?
Jeff, do you want to go first?
Yeah, I'd say, you know, rule of 40 has been one I think I've been monitoring probably the closest over the last number of years. Cash runway as a CFO, you know, that's something that you wake up sweaty some mornings if that cash runway is a little bit lower. But I definitely, you know, NRR, I think is, you know, really the one that I'm seeing resonate the most, and having a lot of good debate. The investors really are interested in understanding that number, because it tells your story over a long enough timeline that it really helps depict the health of your relationship with your customers.
Okay, cool. I'm going to double down on NRR as well. So that will be one of my top 3 as well. I think NRR is just that all-encompassing everything metric that tells you which cohorts, which customers, which channels are producing positive NRR. So they're expanding more than they're churning or downgrading. So that's definitely one of the ones. And that's echoed by most of the investors today. Most investors will look at and demand companies that are improving their NRR. So that'll be one. I'd say on the product side, one of the ones that we look at, obsess about, is activation rate. Now, activation rate is a metric that a lot of product-led companies use, but it's different for, you can't compare one activation rate to another activation rate. So at a different company. Activation rate is something that you have to study over a long period of time. And then you say, okay, these are the folks that have gone through the product in a certain amount of time, and we consider activated. And it's the activated customers that then, you know, with a high degree of probability, they convert at whatever, 20%, 30% into paid customers. So for us, this is one of the earliest leading indicators of if we're pushing out a new feature, or if we're running an A/B test, or if we're running an advertising campaign. We look at activation rate to say, yes, this is having the desired outcome. And we can do that well, like 60, 90 days before we know that it has actually turned into a paying customer. So activation rate and understanding what it means for you specifically, for your product or your service, to have an activated customer is super important. And then I'd say the other one that is interesting is something, it's not super popular, but it's weighted ACV. So you're looking at your annual contract value, but you're not just looking at the average contract value. Averages often lie. You're looking at the weighted ACV. So what you're trying to do is you're trying to figure out where's the gravity of your best ACV. And again, you can cohort that, you can segment it different ways. So which customers are performing that 80-20 rule, as opposed to just looking at your overall average ACV. So that weighted ACV, and that's one that is defined on Metric HQ. It's actually a super cool one to look at. So interesting for the math people out there.
Thank you.